AVA loan may be one of the most powerful mortgage benefits available, but it is also one of the most misunderstood. Many veterans hear zero down and assume the loan is automatic. Some sellers believe VA financing is difficult, and some buyers never use their benefit because they think they can only use it once. Today, I'm going to explain how VA financing actually works, why it can be such a strong option, and the mistakes that can cause an otherwise good VA loan to fall apart. First, the Department of Veterans Affairs does not normally lend the veteran the money. The loan is made through a private mortgage lender. The VA guarantees a portion of that loan, which reduces the lender's risk and allows qualified veterans to receive favorable financing terms. The best known advantage is the ability to purchase a home with no down payment. In fact, most VA-backed purchase loans are made with no down payment. There is also no monthly private mortgage insurance. That is a major difference. On a conventional loan, putting less than 20% down will normally result in monthly mortgage insurance. FHA financing also includes mortgage insurance. With a VA loan, the qualified veteran may finance the entire purchase price without adding monthly mortgage insurance to the payment. But zero down does not mean zero money needed. The buyer may still have closing costs, prepaid property taxes, homeowner's insurance, interest, and other expenses. Those costs may be paid by the veteran, covered through lender credits, negotiated with the seller, or handled through a combination of strategies. VA financing also includes a funding fee in many cases. The amount depends on factors such as the type of loan, the down payment, and whether the veteran has used the benefit before. The funding fee can usually be financed into the loan. Some veterans are exempt from the funding fee, including certain veterans receiving compensation for a service-connected disability and certain eligible surviving spouses. This is why the Certificate of Eligibility is so important. The COE confirms that the borrower has earned the VA benefit. It also shows how much entitlement is available and whether the borrower may be exempt from the funding fee. Another major misunderstanding involves loan limits. A veteran with full entitlement does not have a VA-imposed loan limit. That does not mean the veteran can borrow an unlimited amount. The veteran must still qualify based on income, credit, debts, assets, and the appraised value of the property. If the veteran has partial entitlement because another VA loan is still open or because of a previous VA-related loss, the calculation becomes more complicated. A down payment may be required depending on the remaining entitlement, the purchase price, and the county loan limit. This needs to be calculated before the veteran starts making offers. VA underwriting is also different from conventional underwriting. Debt-to-income ratio matters, but it is not the entire decision. VA loans place significant emphasis on residual income. Residual income is the money the family has left every month after paying major obligations, such as the mortgage, taxes, insurance, installment debt, revolving debt, and certain household expenses. The required amount depends on the family size, the loan amount, and the region of the country. This is one reason a veteran with a higher debt-to-income ratio may still qualify. If the borrower has stable income, solid credit behavior, strong residual income, and other compensating factors, the overall loan may still make sense. At the same time, VA financing is not a free pass for poor financial management. The lender still evaluates the borrower's payment history, employment stability, income, debts, and ability to repay the loan. The VA itself does not establish one universal minimum credit score, but individual lenders may set their own credit score requirements. That is an important distinction. A borrower who is turned down by one lender may not necessarily be ineligible for VA financing. The borrower may simply be running into that lender's additional requirements. The property must also qualify. A VA loan is primarily designed for a home the veteran intends to occupy as a primary residence. It is not intended for purchasing a vacation home or a traditional investment property that the veteran will not occupy. A veteran may purchase a 2, 3, or 4-unit property using VA financing, but the veteran generally must occupy one of the units as a primary residence. The VA appraisal is another area of confusion. The appraisal establishes the property's value and reviews whether the home meets VA minimum property requirements. It is not a complete home inspection. The appraiser is not there to evaluate every component of the home or guarantee that nothing will break after closing. A veteran should still seriously consider hiring a qualified home inspector. Here is the professional way to think about VA financing. Do not begin with the question, how much can I buy with zero down? Begin with, what payment fits my budget? How much money will I have left after closing? And does this purchase strengthen my financial position? Zero down preserves cash, and that can be extremely valuable. But preserving cash only helps when the buyer has a plan for that money. Emergency reserves, moving expenses, repairs, furnishings, and future maintenance still matter. A well-structured VA loan combines the veteran's earned benefit with responsible financial planning. The VA loan is not a second-class mortgage, and it should not be treated like one. It can provide no down payment financing, no monthly private mortgage insurance, limited closing costs, competitive terms, and the ability to use the benefit more than once. But the loan still has to be structured correctly. Verify the Certificate of Eligibility early. Confirm the available entitlement. Understand the funding fee. Review residual income. Evaluate the property before making the offer. And never confuse a VA appraisal with a home inspection. When those pieces are handled correctly, VA financing can be one of the strongest home purchase tools available to the men and women who earned it through their service. Now go win the day.